traders. It's Zoran Kresovic here from Eightcap, and what an incredible overnight in terms of the financial markets and everything that's going on with regards to the actual macro news that's come out of the US, with CPI data coming lower than what market anticipated, causing shockwaves across multiple asset classes. And we can actually see quite elevated moves in general on all market fronts, but especially in the US dollar treasury yields or the fixed income market, as well as the equities and risk on sentiment in terms of shares as well. So how about we actually get started for today? Purely, I'd be focusing on the CPI data. Also on Thursday, tomorrow morning, Australian Eastern Standard Time at 10:30, we've got news out of AU, Australia, unemployment data as well. So let's actually talk about the CPI data first and what it means for the financial markets at the moment, because it's driving all the headlines and news across the globe. And we've seen US dollar index or US dollar against all the major currency or basket of currency pairs dropping 1.57% overnight, which is a quite aggressive move. Probably first time we've actually seen something like that in well over a year. On the contrary, what we've seen is actually a lot of major pairs appreciating against the US dollar overnight. Also, what we've actually seen is equities. So S&P 500, NASDAQ, ASX 200 as well today, really pushing upwards. NASDAQ is actually just about to test all-time high. So that's something for you to consider or something to look at if you are trading index markets as well. But let's get stuck into it. So consumer price index came out of the US last night, obviously lowest numbers in a couple of years time. So month on month, if we actually have a look at the CPI data, which is excluding food and energy, or in other words, what we like to call it trimmed mean inflation, is actually come at 0.2%. So that's lower than what market was actually anticipating at 0.3%. A number of factors, obviously, for that figure. And also, if you have a look at the actual year-on-year number as well, you can see that it came out at 3.2% actual versus previous at 3.7% and forecasted 3.3. So that's quite a dovish move for US dollar, and risk on sentiment prevails in situations such as these. What do we take out of the CPI that came out? Well, if we exclude the volatile items such as food and petrol, and we've seen both the headline and trimmed mean come lower than what market was anticipating, purely on the basis that obviously crude oil has been coming off quite heavy at the moment, and seems like there's been some softening data coming in terms of all other aspects of consumer price index, such as shelter, rentals, etc. So it looks like we are on the right trajectory. It looks like obviously Fed might be pausing rates in the month of December and January, despite the comments from the Fed Jerome Powell the other day stating that inflation is still not within the band where it should be, and therefore they might consider doing another 25 basis points. Just to put things into perspective, market is actually pricing close to 0% chance that we will get another rate rise out of the US and in the month of January and December. So market is actually obviously factoring that in, and therefore we've actually seen ugly moves in US dollar. So how about we actually turn our focus now on Aussie versus the USD? And there is actually a number of reasons that I would like to look at it for. Number one is really doing a sideways consolidation range since August 2023. And as you can see from that point up until now, we can see a range bound trading for quite some time. To be honest, I'm expecting Aussie dollar to actually come off a little bit lower in the months of September and October and basically test that 62 cents. The reason why I say that is because if you go back all the way to 2022, one of the lowest points in 2022 was Aussie getting 62 cents. Now, not necessarily does it always unfold as we actually anticipate and wish, but what we can see right now is Aussie steaming forward and gaining some traction as buyers are anticipating that, contrary to the actual Fed, here in Australia, RBA or Reserve Bank of Australia might be lifting rates in the months of December or February because there's no meeting in January. The reason for that is because we've still got a strong consumer price index in Australia, driven mainly by the labor sector, services sector, as well as housing market. Given the fact that, we will be receiving approximately 350,000 immigrants in the coming year or so, the demand for housing, the demand for services sector, the demand for labor sector will be continuing to rise. And, RBA has actually come out and anticipated that they're reconsidering or readjusting the inflationary figures for the following year, and upping the band a little bit, indicating that it's likely that we will get more interest rate rises here in Australia. But not only that, if you have a look at the Reserve Bank of Australia in comparison to all the global banks across the globe, we can see that our terminal rate at the moment sitting at 4.3% or 4.35% is actually way below the rest of the markets across the globe. So for example, New Zealand is obviously starting to basically drop their interest rates, Fed close to the upper band as well, and obviously starting to factor in they might do interest rate cuts in June 2024. Bank of Canada, European Central Bank, Bank of England, all of their terminal rates are way higher than here in Australia. So on the back of that, if you look at the macro views, what we can see is that Aussie appreciated overnight 2%. That's a very punchy move. And if we do a short-term bar analysis, looking predominantly at the bar on 14th of November, and compare that to the previous bars all the way from 6th of November, we can see that over the last couple of days, Aussie has appreciated so much, covering the losses for the previous week and all the way from the 6th of November. So that's how much the buyers are actually dominating the current market. The level here that I've got at 64,827 seems to be a major resistance level, at least in the short term, and looks like that level is being actually broken. The important thing right now will be for Aussie to hold that and find some consolidation, find the buyers, and essentially try to push that price to continue further upwards. So the next level that we might be looking at is the 66 cents. That's the next major level, and that's actually coinciding nicely with the Fibonacci level that I've actually got from the peak of 14th of July all the way down to the lowest low 26th of October. So what we can see is that that Fibonacci of 50% might provide a short-term resistance. And if Aussie was to break that level, buyers will actually continue purchasing Aussie on the back of the macro fundamental news that RBA might be lifting rates or continue to do so. And on the contrary, the US dollar is gaining weakness. We might actually see Aussie move out of the sideways range and continue the upward range towards the 68 cents. Something else to consider as well, or that's benefiting the Aussie dollar, is the data that come out of China. So what we can see is the IMF, International Monetary Fund, has increased or revised figures for the GDP growth for China for the rest of 2023 and 2024. On the back of that, obviously, the demand or the imports from China in China are actually appreciating at the moment. And given the fact we have heavily skewed towards the Chinese economy, this might be something that would benefit Aussie dollar. We are also looking at the contrary, so downside as well. If Aussie was actually to come back into this sideways range that's been kind of moving for past few months and breaks below that level, then the next level of support should be around 62 cents. To be honest, at these levels, the way macro playbook is actually playing across the world at the moment, and the figures from the CPI data that's coming out of the US right now, it does seem that that we might be more skewed towards Aussie appreciating, at least in the short term, towards that 65 or 66 cents. That's probably a short-term upside. Also, if you have a look at Aussie's broken through the 200-day financial moving average, it's broken that level, but we need a clear breakout above the 3rd or 4th of November peaks. Higher trough can be classified and confirmed, and we might see actually more upside on Aussie. RSI, 14-day RSI is still actually not indicating overbought territory. It's actually within that 50 to 60% range at the moment, so we could be skewed for a little bit more upside on that. Volatility index is something that we should be looking at as well, something to consider. Vols have actually come off quite significantly at the moment, and it seems like the market is broken through between the rock and hard place, as they would like to call it, because what we're seeing right now is actually a change of sentiment and shift in the market in general. It looks to be that US dollar is obviously weakening. Bond yields are actually weakening as well. And seems like what we're going to talk about over the next few months is whether we have hit a ceiling with regards to the rates and whether we are looking for the next move, which will mean the cut. I hope that makes sense. Aussie obviously appreciating nicely. Euro, pound, all the majors are actually doing quite well against the US dollar right now, but we've got unemployment data on Thursday. The market consensus sits at 3.7% right now for the prior month, and with the month of September being at 3.6%. So that's something to consider or look into as well. The wage index data came out today at quarterly 1.3%, in line with the market expectation. I hope you have a wonderful day and happy trading, and we shall talk next week again. Take care. Bye-bye.